We're the deep value part of Franklin Templeton, and what we do more so than others is buy things probably when they're horribly out of favor. We like to buy things that have what we think is a lot of upside potential and limited downside risk, which typically means it's trading down near a low point.
The Beacon Fund, for example, looks for deep value opportunities. In your presentation, you talk about consistent performance with below average risk. How do you get that right, considering that deep value one often associates with high risk?
It's kind of a multi-pronged approach. One, we build very widely diversified portfolios, so we invest in a lot of different securities, which helps limit our downside risk. And downside risk control is critical to generating not only good relatively short-term performance, but long-term performance as well. And we, in addition to investing in undervalued equities, do something that's unique in the mutual fund world. We invest in merger arbitrage situations and distressed securities and some private transactions as well. And all of those things, when you put them in one portfolio, because of the non-correlations of those different types of investments, tends to lower the overall risk profile.
How significant a role do distressed securities play in the overall makeup of the portfolios and the Beacon Fund in particular, which at the moment is the only one that is available to South African investors?
Right. Well, it'll typically run anywhere from a low of, let's say, 0% if there are no distressed opportunities out there, meaning companies going through reorganization, or all the way up to a high of, in a practical matter, probably 10, 11, 12% of the portfolio. The way in which we view it, quite frankly, is a company is probably not going to be more cheaply priced than when it goes through bankruptcy or reorganization. And as it goes through that process, if we can get involved early enough and help try to drive a successful reorganization, then we can participate in the equity price improvement after the new company comes out of reorganization.
Now, some houses steer well clear of stocks that are involved in merger activity, but the Mutual Series actively looks for those. Take us through the process.
It's the upside potential and the limited downside risk.
There's also a lot of risk involved if a deal falls apart, when there's a deal premium built into a particular stock price.
That's part of the analysis that we go through. In any situation, you're always looking at upside potential, downside risk, and you're trying to quantify that as much as you can. What's the potential here? What's the potential downside if the deal falls apart? And you're right, there is a binary payoff. As part of our analysis, we look at the structure of the deal. We anticipate what the problems might be and what might cause the deal to fall apart. And then as well, we look at what the upside potential might be. And the attractive part to us is that, assuming the deal goes through, what looks like a relatively short kind of time frame for a return, and a relatively short return, let's say an 8 to 10 to 12, 15% return, if you get that over a 2, 3, 4 month basis, on an annualized basis, that's an extremely attractive return. And that's why we do it. Again, it's an extremely attractive return with limited downside.
What are some of the recent examples of the likes of distressed securities or merger arbitrage opportunities or undervalued stocks that have come to the fore from a performance perspective?
Sure. I'll give you a great example of an undervalued situation that we stuck our toe in the water, so to speak, a little while ago, and that's American Express, which is one of the premier card issuers around the world. It had come down from a price of, let's say, 65 down to the low to mid 40s, and we started to get interested, and we took a tiny little piece, knowing that the earnings were going to be coming up and knowing that there probably could be some downside risk given what's gone on in particular in the U.S. market with the U.S. consumer and the economy. So we took a little piece, and then they announced their earnings, and the stock went down to about 38 or 39. So it went down a little bit, but it absorbed worse news than what not only the market expected, but also what we expected. They still announced earnings, by the way. Market was looking for about 87 cents, I think, and they came in at about 56. So on a percentage basis, a huge hit to expectations, but still producing solid earnings. And we're evaluating now whether or not we should be buying more of the position, obviously, because we value it considerably higher than where it is. And when the company returns to a more normalized earnings period, we think the earnings will be much higher. as well. If you look at the business model, about 50% of it is the spread-related business, which is the interest that they earn on the accounts receivable that are credit card balances. But the other part of their business that is not related at all to interest rates or the economy is the fee-based business. It's basically the interchange fees that they charge for all the retailers and everyone who uses the cards. And that's a very steady business. So it's a very enviable set of businesses and a very strong ROE, return on equity performer, and looks potentially very attractive to us now.
When you're involved in deep value or looking for deep value, it's not all going to be plain sailing, but how do you deal with the performance detractors?
Two ways. One, if the situation at the company has changed significantly and it looks to us like the business model might be permanently impaired, then that's going to change our estimate of the value of the business. And in that case, when we change the estimate of value of the business, if it no longer meets our investment criteria for risk and return, then we're going to sell the position and we're going to get out of it. On the other hand, if we evaluate the situation and it's not a situation where either the company business model is permanently impaired or they've taken any significant hits to equity. Perhaps maybe the company is announcing lower earnings, as American Express did, but they're not taking a hit to equity or a hit to book value, which to us represents a permanent loss of shareholder value. Well, if it's just down because the earnings are down because the economy is down, then if the price of the stock is down, arguably that might present an opportunity for us. So one of two situations: either we sell it if it's permanently impaired, or perhaps it's an opportunity for more investment at lower prices, assuming everything is still okay.
What are some of the big bets that the Mutual Series has taken in the past quarter?
Oh gosh, in the past quarter, well, I tell you what we're thinking about, where we think there's a lot of opportunity. That's in a lot of the U.S.-based and to a lesser extent perhaps some of the European-based financials. As everybody knows, they've been under a huge amount of stress. You've seen companies like, and I'll talk about this because we don't have it, but you can see something like Citigroup coming from 55 down to less than 20. Here's a stock that's lost 60% of its value. A lot of U.S.-based financials are in the same situation. It's not only financials, it's stocks that are related to the home building industry, which have fallen off in many cases even more. And it's stocks that are related to the mortgage industry. It's the areas of the highest stress that look to us like they might be providing the most opportunity going forward.
If you look at your current strategy compared with 6 months to a year ago, how's it changed?
Oh, no different. We don't think about investing any differently any day because of anything that's gone on in either the economy or is going on politically. If anything, the noise about what's going on in the world might create opportunity for us. But we stick to our knitting. We stick to what we do best, which is evaluating businesses. And oftentimes, the noise of the day allows us the opportunity to go in and buy great businesses at really attractive prices.
From a South African point of view, has there been much interest in the Beacon Fund, and what are the plans to bring similar type products from the Mutual Series to South Africa?
Well, we only have one fund here in the Mutual Series lineup that's approved by the FSB, and that is the Beacon Fund. But we're working to try to get a couple of more funds on the platform here, and hopefully we'll have some luck in the next little bit.